We're here with Jason Holter, Secure National Mortgage, and we're going to just talk about some current trends, address how they impact new home buyers, maybe even seasoned veteran home buyers. Let's get a little bit of your background.
So I started mortgage lending back in 2003. Didn't know what I was going to do for a career, and I was going to be a chiropractor growing up.
Oh, there you go.
And with my dad. And that didn't happen.
Yep.
And 24 years old, I was trying to figure out what I was going to do with my life.
Yeah.
And fell into mortgages. It was just, I didn't know that mortgage had a T in it. No clue. Like, no, that wasn't the deal, growing up. And
well, when you say it with the Texas accent, it definitely doesn't have a T in it.
Well, it still doesn't. Sometimes I still spell it wrong, but I enjoyed it. It was a sales job. It was just basically, helping people obtain financing to buy homes.
Yep.
And back when I started, anybody could get a loan. There was really no rules back then. It was a wild west.
Well, this is pre-2008.
Correct.
So the government hadn't clamped down on everything yet.
Well, the government's maybe started it with, hey, you need to lend to more people.
Yeah.
So they expanded their loan programs to where you didn't have to verify income or assets or any of that stuff. And so we went through the 2008 meltdown and just learned a lot of things, but the scary part of that in 2008 was overnight, 75% of our loan products were gone.
Yeah.
It was one day we had them, the next day we didn't.
That's pretty scary.
Oh my gosh. We were thinking, it was like three things happened that year. It was right around the same time. We had a hurricane. Our town was messed up.
Yeah, that's right.
And
I just moved here.
Yeah, and then Lehman Brothers and everything collapsed.
Mm-hmm.
And so we're looking around thinking, oh my gosh, what are we going to do? 75% of our loans are gone.
Yeah.
And so it was a scary time back.
So we were talking on the phone just the other day, and it was just a brief conversation, but you said the job market's trended up recently,
Right.
And how that impacted the rates.
So it's crazy what all goes into a mortgage rate. The reason that rates have gone up so substantially over the last year and a month or so is inflation. But so what's crazy with the job market is in the past when they said recession, it's 2 quarters of negative growth.
Yeah.
Okay, so that's
They moved the goalposts on that one.
that happened last year, and the definition changed. So in past recessions, what happens, the way that I was told is a recession is when your friend loses their job. A depression is when you lose your job. And so basically when recessions happen, people quit spending money. Yep. They save, they just buy what they need. There's no extras. Started going. So the rates have gone up over the past year. The Fed's hiked 5 or 6 times, 4.75% total.
Wow.
So it's been pretty significant.
Yeah. That more than doubled.
Oh yeah.
The rate that we were at. We were refinanced at a 2.8.
Right. Yeah, no.
Rock bottom.
Yeah, you can't get there. Right. We're not, and I don't know that those rates will come back.
Yeah. I think that's one thing we need to understand looking, in hindsight, 2019 rates, that's where we're at right now. Maybe a little higher.
Right.
But they aren't 1980s rates.
Right. There was a deal that we were looking at, and, whether, say we got in a deal today, it was like a $400,000 loan at 6.5% interest rate. Say we could do that deal today, but you wanted to wait for that deal to come down to 5.5. Well, if we took the difference between the principal and interest on those two deals, it was $280 a month. So you had to pay that higher deal for a year, the higher note for a year, mm-hmm. and then the rates fell to 5.5. Well, you might be able to get that deal today for what it cost, but if 5.5 comes next year, then there might be multiple offers on that deal, and you might have to pay $15,000 over.
Right. Yeah. Yeah, that's a good point. They're trying to find that balance. That time is money, mm-hmm. and you're trying to find that home to get your family into. Mm-hmm. And we think we'll wait for that lower rate, or the higher rates are coming. I'm going to wait. Mm-hmm. And by that time, you've missed out on the house you could have had. And had rates been lower, you would have missed out on it anyway.
Right. Because once that 5.5 comes back, they can't prevent that from happening. There's a whole sideline of buyers just hanging tight and watching.
Right.
Just hanging tight, just like,
Yep.
they want to buy. They don't want to overpay. And, they've looked at, if you get caught up in the news, they sell on fear. They sell on worry and panic. And
well, it's regional. I mean, what may apply on the national news may have zero bearing on the Houston market.
Right. They have markets in cities that have had some pretty substantial price cuts. Austin being one of them. Mm-hmm. Some deals out in California. Florida's doing absolutely amazing.
Right.
I was talking to somebody the other day, waiting for one or two things to happen, waiting for either the home prices to come down significantly or the rates to come down significantly. And the deal is, if we get back to 5.5% rates, which is coming, I just don't know when, right? We're just as busy as we want to be.
Yeah. Yeah.
The only reason rates went up is because the Fed printed too much money. So there's, so.
I think we had a realtor breakfast last month, and they brought in an appraiser.
Right.
He said about 40,000 on average lower on the home prices they've noticed.
So the thing with appraisal, it's kind of crazy how they work, because they got to use, the goal is to use the last 6 months of data. Well, there's not a whole lot of fire sales going on yet.
Mm.
The people, I believe the people that are in the market to sell their house have to sell their house.
Because of job or
divorce or family situation or maybe health, whatever that looks like.
Yeah.
But so since October, the report that we pay attention to the most in the mortgage deal is it's called the CPI report, Consumer Price Index. Since October, the CPI has come in low, lower than expected. Well, this last Fed rate hike, they did a quarter. Previous to that, it's been 75 basis points. So they did a quarter, so the market cheered. 2 days later, the jobless or the unemployment numbers or the job numbers came out, meaning how many jobs were added in that particular month. They were expecting around 115,000, and they added over 500,000 jobs. And so when positive jobs are terrible for mortgage rates.
Well, because there are more people that now probably qualify, right?
They're not impacting the deal like they have before in recessions. People are not losing their jobs or adding jobs. And so, when they can back off is when they break it, whatever that looks like. Mm-hmm. When the Fed raises the rates, it's for short-term lending. Auto loans, credit cards, home equity lines of credit,
right.
Business lines of credit. Does not necessarily impact mortgage rates.
Right. And I think a lot of people are confused on that.
Well,
how does that work?
So mortgage rates go into, when people get scared, mortgage-backed securities and treasuries have always been, it's government debt. So it's considered a safe haven. So when people got scared, oh my gosh, my stock's going to crash, about treasuries, mortgage-backed securities. And when you have more buyers than sellers, your yield goes down, which means the rates go up. And vice versa. Mm-hmm. So when there's chaos in the markets, the Dow's dropping 2,000 points, and you see the mortgage-backed securities, those are dropping, or the 10-year treasury dropped down to 0.7.
Right.
Well, that means the rates are bottoming out because there's more buyers than sellers. China's the biggest holder of treasuries. They've got like 1.1 trillion. Japan's close after that. So when things are going good, the economy's running, they'll pull money out of mortgage-backed securities and treasuries to put in the stock market. But so after the Fed raised the rates a quarter, the market cheered. Mortgage rates actually fell for 2 days.
Mm.
Then this monster jobs report came out and shot the rates up.
So how much did it move?
So it lowered a quarter. So Feds raised a quarter. 2 days it lowered a quarter to 3/8 in those 2 days. Jobs report came up, it shot up half a point. And since that was February 3rd.
Right.
And so the last 2 weeks, we've lost 203 basis points in mortgage-backed securities. When they go up, the rates come down. When they go down, when I say lost, they've gone down. Mm-hmm. When they go down, the rates go up. And so the rates are probably 3/8 of a point higher than they were 2 weeks ago.
So number-wise, what?
So they went, we were locking 6.25 maybe, ballpark. And our price went out earlier today at 6.75.
Wow.
So this is for excellent credit,
Wow.
So
we had just crossed the 6 mark. I felt like
we were hopeful. We were like, oh my gosh, because there was on the rate sheet, we saw 5.99. We're like, oh my gosh, this is it. Come on, it's been tough.
Oh man.
And then the jobs report smoked us. And that's crazy because good news for the economy,
right?
You think would be good news for everybody. That's not how it works.
So how many closings are you seeing right now?
So the number of applications has increased tremendously over the last 2 weeks.
Yeah, I feel it.
It was like a light switch got turned on. Yeah. I remember it was Tuesday or Wednesday of last week, and there was like 7 people that applied in one day. I'm like, oh my gosh.
It's happening.
That's why we kept our team. That's why we have all these people.
Right.
We've got lots of support so that we can, when these times come, we're not overwhelmed.
Right.
Everybody's busy. And I said to myself, I was like, oh my gosh, we're in 2020 again? Like, just how busy it was, because at the end of the day, I was mentally drained. Mm-hmm. Like, it was just, we got them all taken care of. But it was, the last 2 weeks has been significant. And it's, we're getting, we had a few contracts come in that have busted out for different reasons.
Yeah.
One, got a bad health report. Another one, there was too many issues with the inspection. So we're getting contracts and busting out looking for another
just like
one.
They normally do.
Yeah.
So are you seeing, in terms of down payment, are you seeing mainly 5%, 10%? Are you just seeing it all?
So we talk to them, because could they do 50% down?
Yeah.
Really, we talk to them about money, as far as, hey, consider this. We've got some people that want to put, $100,000 down on a deal, and they've got $60,000 in debt. Does it make sense? When we run a scenario, here's what I would do personally. Have you considered paying that debt off, freeing up $1,300 a month or whatever it is in positive cash flow, because those are gone.
Yeah.
And then maybe doing a little bit less down payment right now, because the deal is every loan that we're writing right now, and this is probably for last year, every loan that we've written and we're currently writing, we're expecting to refinance the next 12 to 24 months. When it financially makes sense.
Is that because you're anticipating a drop in interest rates?
We are.
Okay.
I don't know when that's going to come. I don't know where they're going to go to.
You're just hoping that equilibrium will hit.
Absolutely. Yeah. It has to. Down payment, if we look at it, because we are anticipating refinancing a bunch of these loans anyway, cash is kind of king right now.
Yeah.
With the fear and uncertainty, and then if you watch the news at all, the panic and all that stuff going on, all that stuff's out of my control.
Yeah. I
can't control any of that stuff. I can't sit there and worry about it because I'll drive myself crazy, right? Yeah. But I'd rather, if something did happen, I'd rather have some money in the bank.
Be prepared.
Versus saving, because if you look at a mortgage, and you can compare it in $10,000 increments, put $15,000 down versus $30,000 or whatever that looks like. It's not very much a month. So here's the deal. When I talk to people about, ultimately at the end of the day, my job is to write options and maybe a second set of eyes on it. At the end of the day, it's your investment. It's what you're going to do with your money.
Yeah.
The deal with making a large down payment is if something happens and you don't have a cushion, and whether you get laid off or get sick or whatever that looks like, the only way you're getting that money out is a cash out refinance or selling that house. And for people who haven't bought a house in several years, if credit's pretty good, back in the day, there was a very limited supply of mortgage insurance companies. You don't put 20% down, you got to pay this mortgage insurance, right? Conventional loans. And since there wasn't very much competition, they're expensive, right? So after 2008 happened, let everybody out, and then people started popping back in the market. On every loan that we do that has mortgage insurance, we shop it out at 6 different places at once to make sure we're getting the very best deal we can get.
Yeah.
So some on a 5% down deal, if you got great credit, $400,000 loan, mortgage insurance might be $50 a month.
Wow.
55, 60, nothing crazy.
Yeah. Because that's conventional eventually goes away.
It will.
Yeah.
It will.
Or FHA. you're stuck with it.
So FHA, you're stuck with it until you're able to refinance down the road when you get some equity.
Sure.
But government loans right now, FHA, VA, their rates are cheaper than conventional right now.
Wow.
Yeah.
So, all right. Well, thank you, Jason. That was really enjoyable. So
thank you for having me over, and look forward to doing some more of these. This was fun. This is completely cool. I'm comfortable.